Index funds, ETFs, mutual funds, hedge funds. You've heard these words, maybe from a finance influencer, a coworker, or a Reddit thread at midnight. And every time someone says, just invest, like that explains anything. But here's the problem nobody talks about. Picking the wrong type of fund at the wrong stage of your life doesn't just slow your wealth, it can quietly drain it. Through fees you didn't know you were paying, through risk levels you didn't know you were taking on. Did you know that the average actively managed mutual fund charges fees that measure over a 30-year period can quietly eat up to 30% of your total returns? Not your losses, your returns. That's the difference between retiring comfortably and retiring late. In the next 10 minutes, I'm going to break down all four fund types, what they are, what they cost, who they're really built for, and which one is most likely to actually build your wealth. No jargon, no fluff, just clarity. Before we break down each type, let's make sure we agree on what a fund even is, because everything else builds on this. Here's the simplest way to think about it. Imagine you and 9 friends all want to invest in the stock market, but individually, none of you have enough money to buy a diversified mix of stocks on your own. So instead of each going it alone, you pool your money together. Now you have real buying power. You spread it across dozens or even hundreds of companies. You share the gains, you share the losses, and nobody has to manage it solo. That pooled pot of money, that's a fund. In plain English, a fund lets you own a small piece of a lot of things instead of a large piece of one risky thing. It's diversification made simple. Now, the 4 types of funds we're about to cover all work on this same basic idea, but the way they're managed, the fees they charge, and the people they're built for, completely different. Coming up, the one fund type that Warren Buffett publicly recommends for most people, and the surprising reason most professionals still can't beat it. That's wealth clarity. Let's start with index funds, probably the most talked about on social media, and for good reason. An index fund doesn't try to pick winning stocks. It doesn't have a hotshot manager making bold calls. Instead, it simply copies a list of companies, called an index. Think of an index like a curated playlist. The S&P 500 index is a playlist of the 500 biggest, most established companies in the United States. Apple, Microsoft, Amazon, Berkshire Hathaway, they're all in there. When you invest in an S&P 500 index fund, you're not betting on any one song. You're buying the whole playlist. In plain English, when the U.S. economy grows, your index fund grows with it. You don't need to predict which company wins. You just need to believe the economy keeps moving forward. Because there's no active manager making decisions, index funds are passively managed. And that changes everything when it comes to cost. Most index funds charge an expense ratio, an annual fee, of just 0.02% to 0.20%. On a $10,000 investment, that's $2 to $20 per year. Compare that to what's coming next, and you'll understand why Warren Buffett once said, in a letter to Berkshire Hathaway shareholders, that for most people, a low-cost S&P 500 index fund will beat the majority of professional investors over time, not occasionally. Over time, index funds are also low risk relative to picking individual stocks. Your money is spread across hundreds of companies, so one bad year for one company barely moves the needle. One thing to know, index funds are priced once per day after the market closes. You can't buy at a specific price midday. For long-term investors, that's fine, but it's worth knowing. Coming up, the fund type that promises to beat the market, why most of them fail, and the one scenario where they actually make sense. Mutual funds look a lot like index funds on the surface. Same idea, pooled money, diversified assets, but the key difference is in how they're run. Mutual funds are actively managed. That means there's a real human being, or an entire team sitting in an office every day, analyzing markets, reading earnings reports, and deciding which stocks to buy and which to sell. Their job is to beat the market, to outperform that S&P 500 playlist we just talked about. In plain English, you're not just paying for the fund, you're paying for the expert, and that expertise costs money. Mutual fund expense ratios typically run from 0.5% to 1.5% annually. That might not sound like much, but on a $10,000 investment over 30 years, the difference between a 0.1% index fund fee and a 1% mutual fund fee can compound into tens of thousands of dollars out of your pocket. Here's the uncomfortable truth. Study after study, including research from S&P Global, shows that over a 15-year period, more than 85% of actively managed funds underperform the simple index they're trying to beat. That doesn't mean mutual funds are useless. If you want exposure to a specific sector, country, or strategy that isn't easily captured by a broad index, mutual funds can fill that gap. And some investors simply like the idea of a human making the calls. Just go in with your eyes open about the fees. Coming up, the fund type that requires millions to even get in the door, and why the people inside it are playing a completely different game than the rest of us. If index funds are the reliable family car and mutual funds are the upgraded model with a driver, hedge funds are a private jet. Expensive, powerful, and definitely not for everyone. Hedge funds are private investment vehicles. They're not available to the average person. To invest in most hedge funds, you need to be an accredited investor, meaning a net worth over $1 million or annual income above $200,000. These funds pool money from wealthy individuals and institutions, and they use aggressive, complex strategies to chase high returns. We're talking short selling, betting that a stock will fall in value, leverage, borrowing money to invest more than you actually have, derivatives, contracts tied to the future price of an asset. Imagine two people. One invests $100,000 of their own money. The other borrows an additional $200,000 and invests $300,000. If the trade goes up 20%, the second person triples their gain. If the trade goes down 20%, the second person doesn't just lose, they owe money they don't have. That's leverage, high reward, high risk, high stakes, and the fees reflect that. Hedge funds typically charge what's called the 2 and 20 model, a 2% annual management fee plus 20% of any profits the fund makes. On a great year, that's a significant cut. On a bad year, you still pay the management fee. If you've made it this far, you already understand more about funds than most people ever will. Keep going. We've got one more type, and it might be the most practical one yet. Coming up, the fund that trades like a stock, costs less than almost everything else, and gives you flexibility no index fund can match. ETFs, exchange-traded funds, are the newest player in this conversation and honestly, the most flexible. Think of an ETF as an index fund that learned how to trade like a stock. It holds a basket of assets, often tracking an index, sector, or theme, but unlike a traditional index fund, you can buy and sell it at any moment during the trading day at live market prices. In plain English, you get the diversification of a fund with the real-time control of a stock. ETFs are typically passively managed, which keeps fees low, usually between 0.03% and 0.75% depending on the type. Many brokerages let you buy ETFs with zero commission fees, making them one of the most accessible investment tools ever created. Want to invest in the S&P 500? There's an ETF for that. Want exposure to clean energy, healthcare, emerging markets, gold? There's an ETF for each of those too. The flexibility, low cost, and accessibility make ETFs ideal for investors who want to stay hands-on without paying for active management. That's wealth clarity. So, which fund actually builds wealth? Here's the honest answer. For most everyday investors, especially those just starting out, index funds or ETFs are the strongest foundation. Low fees, broad diversification, and decades of evidence showing they outperform most active strategies over time. Mutual funds make sense if you have a specific investment thesis, want professional management in a niche area, and you've done the homework to know the fees are worth it. Hedge funds are for a different game entirely. High net worth individuals willing to accept higher risk and higher fees in pursuit of outsized returns. Not for the average investor. The fund that builds wealth isn't always the flashiest. It's the one that quietly compounds, charges you the least, and keeps you invested through every market cycle. Simple, consistent, long-term. That's wealth clarity. If this video helped you see your options more clearly, like it, share it with someone who's been putting off investing, and subscribe. We break down wealth concepts like this every week. See you in the next one.